What's going on, guys? It is the Zoomer Value Investor here to talk to you today about what I believe are the top 5 stocks I really want to watch this month in December 2022. Now, this is a new series I look to be doing more or less every single month. I just want to kind of give you guys a rundown of what 5 stocks I particularly like the valuations at. I think this is a great series because valuations tend to fluctuate like crazy. So for example, you guys know I'm a huge Google bull and I love to hold Google. It's one of my biggest holdings. However, Google has recently rebounded to a price of $101 after a low of $83, and I don't particularly find it attractive for a ton of my capital at this time because of this. So that's why I believe this series will be useful. It'll be a great place for me to just kind of like give you guys my thoughts on what I think are attractive bargains in the market, perhaps what I find to be and what you guys should watch. Run down this list. We're going to lead this off with Micron Technologies. The CEO of Micron Technologies is Sanjay Mehrotra. This is a DRAM / NAND chip making / semiconductor company. They're based out of Idaho in the United States of America, and they are actually the only Western world major producer of the DRAM chips. The other major producers are in the Eastern Hemisphere of the world, SK Hynix and Samsung. Micron is a long-term bull thesis. It's a 5 to 10 year play for me. A lot of this really has to do with the expected compounded annual growth rates in the DRAM industry. They are expected to be well above industry standard in that whole technological space. There's expected to be a lot of growth coming from that space, and it really makes sense when you consider all the things that society's trying to do now with evolving electronics, such as 5G, evolving heads-up displays, evolving processors, evolving data centers, evolving electronic vehicles. It makes a lot of sense why society is going to want to scale up its DRAM capability. Esteemed investor Manish Parai recently gave a talk to a whole bunch of university students, and he basically eloquently explained a large part of the bull thesis does revolve around the privilege of Micron being a monopoly and just the general tailwinds that are going to come between DRAM and NAND. Why I think Micron's kind of attractive is you see Micron bounce off a low of $48 here on the technical analysis, and it's roughly trading around $53 today. I think that's a pretty safe, it's a pretty easy area on the technical analysis to trade. And outside of that, if you just want to invest for the long term, it's just a small amount of room until the next technical bottom. Again, pairing back to my Google example, when Google is at a price of like $101 and the last bottom was $83, I mean, that's a lot larger room to the next technical bottom. Moving on, I really wanted to talk about Cleanspark. So Cleanspark is actually one of the highest risk assets I ever talked about on my channel. The large reason of that being it is a microcap company. You're talking about like a $100 million purchase here. You're not talking about no billion-dollar company at this time. But as a value investor, you know that does mean more room to compound if our pick is correct. Now, Cleanspark is a Bitcoin miner asset. You're buying a part of a company that mines Bitcoin very, very voraciously. Bitcoin is a very difficult asset to construct into the real world, and it's a very difficult asset to value. I think a great way to get a personal expertise behind it is to watch the Gary Gensler MIT course. Gary Gensler, now SEC chairman, was MIT professor only a couple of years ago, and he gave a course on cryptocurrency and cryptography and all of the technologies and all of the events and histories behind cryptocurrency. It's about a 20 to 25 hour course. I like to watch it on 1.5 speed, get through it a little faster, you know. I believe Bitcoin's trading at a price around 17,000 today. Now you're talking about a company that just recently reported mining around 532 Bitcoin. I mean, when you consider it's a $100 million price tag on the business at 100 million market cap, that's where Cleanspark begins to look like a deal, because you can, look at the cost of revenues of Cleanspark. They're about 20 to 25% of cost of revenues have to go into actually getting the profits, to mine the Bitcoin. And then you start to really, as a value investor, just kind of quantify the potential and profitability here. And that's not even discussing the potential upsides of the Bitcoin itself. For example, if like the Bitcoin price starts moving up in the markets, I mean, that just means that Cleanspark's next cash flow statements are just going to be that much higher. It's kind of a leveraged play on Bitcoin. I definitely believe Cleanspark has a better chance to 10x or some crazy compounding number than Bitcoin does, and that's kind of why I'm choosing to invest in Cleanspark as opposed to trying to get like the cold storage holding of Bitcoin myself. Continuing down our list, the next one we have is Blackrock Science and Technology Trust. Not talking about Blackrock, the whole company, BLK as a whole. We're talking about BST. This is a different ticker, different holding. This is a trust managed by the Blackrock asset. Blackrock Science Technology Trust is largely a tech stock holding trust, and it actually trades at a discount to net asset value today. And that's just one of the reasons that attracts me to it. You're talking about a good holding in Apple, Microsoft, these generalized big tech cash cows, but also you're talking about a lot of private market projects in this company. So that's one of the nice things about the trust is that, you know, this ticker BST is a really unique way to get access as, you know, an amateur investor, retail investor like myself. I can get access to some of these private markets. You know, venture capital is a really interesting space. It's done well in the last few years, and it's something that really largely, you know, a lot of retail has missed out on. But, you know, the Blackrock Science Technology Trust, they've been one of the few methods that retail has had to be involved in this space, and it is actually outperformed very significantly in benchmark like the QQQ or VOO. Now, historical performance does not mean that future performance will be as great. However, when I look at the portfolio, and then when I consider also on top of that their option strategy, where they write covered calls on their underlying holdings, distribute that out as monthly long-term tax dividend gains to shareholders. When you consider that cash, that monthly distribution of cash, that is factored into that historical performance you see, and that is a large part of the vast outperformance. It is that option strategy from the manager. I don't run a ton of option strategies myself at this time. I'm still waiting for myself to get a lot more capital underneath myself before I'm really starting doing things outside of stock assets. However, that covered call cash premium that you can just generate every single month, it's really addicting to just get that cash payment. And now, one of the costs of, you know, buying into BST, you know, this technology trust fund that is ran by some great professionals, is you are talking about a 1% expense ratio. Now, that is more than even something like an ARK Invest fund or a leveraged fund like a TQQQ. But I would be remiss to say that that 1% expense ratio in the glimpse of the last 5 years, that has been nothing but a blip. Going into the next 5 years, however, who knows? That expense ratio could be a huge, heinous drag. Our next stock here is Warner Brothers Discovery. Now, this is a really interesting play. This is a recent spin-off with AT&T's HBO spun off with the Discovery Networks company. They are merging their medias, combining their assets, and they've spun off into a whole new company. What I really like about this is there's been two major drops that I believe have sent this thing into deep value territory. One of the deep value drops that sent this into deep value territory was the Bill Huang sell-off. Now, Bill Huang got way leveraged. He's a family office trader. If you don't know what family office is, it's basically like the most money you can hold without being technically a hedge fund who has to disclose. So he had a lot of money, but he didn't have to disclose it. Now, Bill Huang sent this into a crazy drop. And what I like about this drop on the charts here is that I think part of it was Bill Huang, maybe like half of it, and then the other half was like retail capitulation. On top of that, after the actual spun off did happen, around like $20, the AT&T shareholders, I believe they were a large part of the selling pressure that came thereafter. I sold this stock down to around like $10, $11 where it's at today. Now, I actually love this company. I look at, like, you know, the list of movies they got coming up, the list of movies they currently own with like the Harry Potter franchise, DC, Filmverse, and then you're getting like Warner Brothers Interactive, like all the games they own on top of that. I mean, it's just a huge IP with just a lot of like content in the library and like an enterprise value of like 50s to 70 billion. Now, one of the big reasons about this company that's, you know, why it's not like going to the moon, obviously it's like a great company and everything, but they are under overwhelming amounts of debt, especially after the spin-off with HBO. Now, while I am interested in this company, despite me as a value investor hating debt, is that the CEO and all of the management have been very adamant about a plan to pay back this debt. And they have been doing it. I mean, they have been deleveraging ever since I've been a shareholder. Things have gone according to plan. So I'm personally just more attracted to Warner Brothers Discovery at a lower price as I can buy the asset. This is also a 5 to 10 year play for me, kind of like what Micron was, but I believe that it is possible that price realization for this asset up to the $30 to $40 range could happen possibly within like 2 years. Now, our last stock is actually a big tech. It is Amazon. Amazon is a really interesting company, and when you look at it, especially from a value investor standpoint, you know, it's really hard to quantify things like PE, forward PE, things of that nature. And while it really may be easy for value investors to just kind of look at things like Amazon not making a ton of profits and things of that nature and just immediately dismiss it, you really got to look at what Amazon is investing into. such as the Amazon Prime Studios that are making movies and films and TV, the Amazon Prime streaming services. They recently made an acquisition in the cleaning robots that clean homes. Like, I believe the company is called like iRobot or something of that nature, and they have that Roomba type device. Amazon's CapEx number is actually quite incredible. And I personally do believe if Amazon really wanted to, they could restructure the entire business to a place where they are, you know, profit focused, you know, perhaps dividend shareholder focused. They've never been a company to pay dividend because they've continually been in growth and reinvestment mode. But being in this mode has actually played out really well for Amazon. It's allowed them to invest in certain things like AWS, Amazon Warehouse Services, which is one of the largest, the largest cloud player in the world right now. And one of the things you also have to really consider is Amazon, you know, is a US-based company, and US does live in that kind of like rules-based capitalism where, you know, if you are kind of doing certain things, then the antitrust can really start getting on you about certain things. Now Amazon, because they're continually spending money, they're not really declaring profits. I think they're tactfully doing this plan where they're trying to get roots in a lot of different industries in the United States. You know, streaming, house cleaning, like all of these different things. They're not trying to just be e-commerce and cloud, and you know, even they're already doing so many different things. They're trying to do almost everything, and they're trying to sneakily do it in this way under almost like the lawmakers in a way by not declaring profits and just continually saying that everything they're doing is an ongoing product that may or may not turn out. And I mean, that's more or less true, but Amazon is kind of just taking over the world under everyone's noses. But I'm not going to get too deep into that. I'm actually going to end the video on that note. I really appreciate your time. Thank you so much for tuning into my video. Peace.